Good evening, and thank you for patiently waiting. Thank you for taking the time on a Friday evening to be with us. Welcome to the Q4 and FY 2021 results presentation. Me and my colleagues, my name is Srini, and my colleagues Srikant, Anshuman, Dinesh, and Sanjay would walk you through both the company and our business segments performance. Uh, I first of all, I just wanted to ensure and wish that everybody is staying safe and keeping well. Please continue to stay safe. Please continue to follow all of the guidelines that are issued by the government authorities on COVID. Please use mask. Please maintain social distancing, and please sanitize as often as possible. So I just wanted to spend the first couple of minutes on the work that we are doing on foundation. Um, in We actually started quite early in 2020 as soon as we realized, I mean, there was a lockdown and we realized that there is a lot of people who are getting impacted. So we had multiple initiatives spanning providing food, providing COVID care, providing health care, providing testing, all of that. So currently we have set up nearly about 1,875 beds, or in the process of adding to a cumulative number of about 1,875 beds. 1775 beds are completely free for anybody. We have 875 beds currently operational between Seven Hills, NSCI, and 100 beds, which is a step-down facility at the Trident Hotel in BKC. As we speak, we are setting up a 1,000-bed COVID care facility in Jamnagar for that region. In addition, we actually are producing medical-grade oxygen, a product that we never did before the pandemic. We have scaled up from virtually nothing to about 700 metric tons daily. This is being provided free of cost to several state governments across the country. Just to give you a sense, this on an average, a patient who is mild to severe, if I were to say that this 700 metric tons is equal to about 70,000 patients every day getting oxygen. In 2020, just to recap what we did, we were the first one to actually set up a COVID-19 facility in India. We set it up in Seven Hills, Mumbai. We set up 250 beds, but we operate about 125 of them currently. And we are given the rest of the beds to BMC to manage. We have also set up COVID care facilities in Lodi, Delhi, and Mumbai. We have provided free fuel for ambulance and those on emergency services. We have provided almost 14,000 ambulances and COVID care vehicles, about 5.5 lakh liters. We had developed RT-PCR testing capacity of about 3,500. We had set up emergency camps across, and we also were one of the earliest to actually ramp up production of PPE kits. And we provide currently, I mean, we're doing fairly large number of PPE kits and masks on a daily basis. So these are some of the other things. As I mentioned, COVID Suraksha, we actually have plans to give free masks to about 1 crore free masks. We are currently distributed almost 68 lakhs across 21 states and 2 union territories so far. And this is to about 48 lakh individuals. What we are focusing is on frontline workers and those in the vulnerable sections of the society. Mission Anna Seva, we're very, very proud that it's the largest program that has ever been operated by a corporate foundation. We had already distributed in 2020 and up to late 2020, we have distributed about 5.5 crore meal equivalents through ration kits, food coupons, and cooked meals to 27 plus lakh people. We are currently, I mean, starting to distribute more meals. We believe that between the months of May and June, we would distribute an additional 2 crore meals. So we are partnering with 80 plus NGOs, state governments, and through our own volunteers of Reliance group of about 2,400 people. In addition, we have also undertaken several community initiatives. We have actually sent out COVID advisory to about 39 lakh people. We have also done, not just for the humans, but for also animal welfare. We have provided fodder and food to stray animals, to gaushalas, to cats, dogs, monkeys. I mean, now as we speak, actually, today we are providing food for animals, including monkeys and horses in Matheran. So these are things which we are quite doing it with a sense of purpose of doing caring for our own community in and around our places. These are some pictures of our health infrastructure that we had created. You can see that, I mean, this is Seven Hills, this is Trident, this is oxygen tanks. All of this actually are providing much needed care in the crisis that we are currently facing. Next, this is the mask that we are distributing with a small pamphlet which is multilingual, which actually provides what is the right process to wear a mask. I mean, it actually, I mean, breaks my heart to see that despite COVID being about 13, 14 months, we still see people not wearing a mask properly. So that actually is one of the concerns that most people have. So we have actually printed this very, very small, and we have also sent it on WhatsApp to all of those people who are part of our Reliance Foundation network. Next, Heyman. This is some pictures from our mission Anna Seva. As I mentioned, I mean, next slide. As I mentioned, we had already done 5.5 crore meals or meal equivalent in 18 states and 1 union territory, 80 plus districts. We are currently in the process of actually doing 2 crore more meals in the months of May and June. So this is our contribution to fighting the battle against COVID, and we genuinely hope that India will emerge out of this as a stronger nation, as a nation that has beaten COVID, and we all are in it together. So all of us will have to work harder together to make this COVID go away and let life come back to normal. Thank you very much for listening to me patiently. I will now request Srikanth to take over and walk you through our consolidated financial results. Srikanth, you're on.
Sorry. Thanks, Srini. Let me start off. First, let me. It was on mute, so good evening all, and let me start off with the consolidated financial results. Net profit at 14,995 crores. It is the highest, sequentially also higher, and significantly higher on a year-on-year. But even after backing out the exceptional items at 14,200 crores, it is about 5% lower QOQ, but 31% higher on a year-on-year basis. But just focusing on the quarter, when you look at revenue, the jump of 25% you see is on the back of the O2C segment, which saw what 21% growth. This is really on the back of higher volumes as well as sharp increase in the prices of feedstock and products. The Q-on-Q EBITDA again benefiting from the strong performance of O2C as well as retail, both grew 17%, offset by lower other income. Depreciation has been slightly higher on Geo side. On the tax side, the tax provision is higher compared to Q3, as we have postponed the tax reversal that was intended in Q4 relating to the reorganization of our businesses. We will synchronize the reversal timing-wise with the regulatory approvals. And then finally on finance cost, continuing to be lower with the pay down of liabilities post the capital flows. Next slide, please. When you look at consolidated EBITDA, as I mentioned, O2C benefiting from higher demand as well as higher volumes and margins. Retail business EBITDA growth was led by revival in store operations as well as digital commerce ramp up. We continue to see digital subscribers growth in Geo. A turnaround in oil and gas business with ahead of plan ramp up of production in the R cluster fields. As you know, satellite fields also we have commenced in April 21 ahead of plan. And the combined production at peak with that 18 SCMD will be approximately 20% of India's gas production. Now, consumer businesses account for almost 49% of our overall segment EBITDA. Just a few highlights. Geo, we are exiting FY21 with 426 million customers. A strong net addition of 15.4 million. You compare it sequentially to even previous quarter, which was close to 5. ARPU at about 138. Overall, when you see JPL EBITDA up 36% year on year, EBITDA margins now at close to 47%, which is almost 600 basis points higher. We are also seeing strong engagement and high customer adoption with 3.3 GB per customer usage of data and about 823 minutes of voice. On retail side, revenues have been pretty strong, in the context of the operating challenges. Fashion and lifestyle and grocery has actually registered all-time high revenues. Consumer electronics was also good. EBITDA at 3,600, again up 41% year on year. We also saw strong progress in terms of store addition. We have added about 826 stores in Q4 alone, when the whole year is about 1,400 stores. But I must say that new COVID, when you look at the impact of the new wave, you can see it in March. When you look at the grocery operational stores, also footfalls, in April is about 35 to 40% of the pre-COVID levels that we saw. So yes, that headwind is there. But overall performance is very good in that context. On O2C, as I mentioned, it is about continuing recovery, up 17% Q on Q. On the back of stable demand, also a lot of supply disruptions coming through, benefiting fuels. It benefited polymers and polyester. I'll talk about that. We were able to significantly optimize our feedstock sourcing. Also, O2C benefited from the fiscal stimulus and also, the vaccination drive, at least globally. Our volumes was higher by 2.7% Q on Q. Overall, oil demand is up 2.5% year on year, though essentially, I would say slightly lower quarter on quarter. Same thing on polymer and polyester also. Yearly demand is up 12% and 21% respectively, but Q on Q is almost flat, I would say. Yeah. So just seeing it from the full year's perspective, the first half of FY21, we saw sharp demand destruction in O2C. We were able to maintain high operating rates. We were able to focus on exports. Similarly, retail too, they were able to negate a lot on the store, on the local lockdowns and its impact on store operations by ramping up digital commerce. Second half, of course, benefited from a sharp recovery in demand. Also, some of the supply disruption benefited margins. We were able to place a lot more on the domestic market. Even retail store operations from a low of 50%, it has an exit rate of almost 95%. Jio has been continuing momentum in terms of adding customers, also the more broader adoption of digital life, and as you could see it in the engagement numbers that I talked to you about, and significantly look at the capacity in terms of carrying more than 5 exabytes a month. In this context, when you look at the overall numbers, revenues on a year-on-year basis were lower. Primarily, I would say, is O2C volumes lower, as well as realizations being lower. And retail business revenues was marginally lower, I would say, but the increased footprints and omni-channel offering did offset the store operations restrictions that were there. Digital services revenue up effectively 30%, more customers, higher ARPU, FTTH rollout. And when you look at it from net profit, including exceptional, close to 54,000 crores, up 35%. Also, apart from the operational points that I mentioned, it also benefited from benefits of deleveraging, lower effective tax provision, and also some gains on asset monetization. Next slide, please. And here, this is just the split EBITDA-wise. The sharp fall in O2C EBITDA that you can see was largely offset by digital services. As you can see, digital services up almost 46% on a year-on-year basis. Also, retail business, when you look at it, EBITDA was flat, with cost management and digital commerce initiatives and investment income really offsetting curtailed store operations. Overall, in this year, I would say that 4.6% year-on-year reduction. When you put the context of what it was in the first half of the year, yeah, I think it is pretty creditable, and really you can attribute it to agile operations and a lot of proactive decision making that we saw right through across businesses. Just a summary on the balance sheet side, continuing to be more investments than debt, 2,200 crores. Effectively unchanged, I would say. And as you know, the overall cumulative cash inflow of this 2,60,000 has been used, to retire debt and other liabilities, and really leaving us with a highly liquid balance sheet, which can then support the next phase of growth. This is just to say that the board has made the two calls with respect to the rights issue. The first call for 314 rupees translates to 13,281 crores of rights, and the payment period is between 17th May and 31st May. And then the second call of 628 rupees, will happen in November. So what we have also done, therefore, is the entire 39,843 crores. We have now, post the board having made the call, we are treating it as part of, it has come on the balance sheet. It is reflected as other financial assets, and also with the corresponding credit to the other equity as share call money account. So with this, I'm requesting Anshuman to take us through digital services, and then hand it over to Dinesh.
Thank you, Shrikant. Good evening, everyone. Let me start off with the digital services, starting with some of the initiatives, efforts that we're making on strengthening the technology core for our Jio Platforms Limited. Be it people, where we're building on talent. Through this year, despite the challenges faced on the ground, we've been expanding the bench strength. The people specialists at JPL, we now have over 8,000 tech specialists working there. We've been running programs to enhance their skills, practices, modifying the organization structure to enable more higher agility, products and not projects. So a bunch of initiatives that we've been taking through the last year on the talent and organization structure for people, orientation to this technology core. On the technology front, a lot of work on the foundational technologies that we have spoken about in the last 2 or 3 quarters when we have presented to you. Really technology-led disruption for the various business opportunities that we see. And this would range right across AI, ML, blockchain, compute, etc., that we have spoken about in the past. Modifying our architecture and practices to enable all the product innovation and platform innovation that we have been doing. And then the whole stack modernization itself, cloud native being one of the key principles of the way we are developing our technology. So everything is cloud native, everything has best-in-class functionalities. And then on the customer side, just keeping the customer in the center of everything that we do. So enabling customer experiences across touch points, enabling higher personalization for customers to give them what they need. And this is becoming even more important as there is much more digital consumption now than used to happen earlier. Using data and insights very judiciously, but using them to continuously improve what we are offering to our customers, and improving the technologies that we've got. So basically, we have got the building blocks in place to drive the technology evolution, the initiatives that we are focusing on at Jio Platforms Limited. We have spoken about some of those in the past, and we'll cover some more in this presentation as we move forward. In terms of performance, resilience and COVID headwinds through the last year, you all know how challenging it has been to operate remotely, and to keep the network running 100% of the time through a whole lot of innovation and initiatives that we have taken. Through the year, we became the first operator outside of China to cross 400 million subscribers. in a single country market. Uh, Through the year, we added 99 million subscribers, gross adds during FY21. We'll cover the numbers for the quarter in a bit, but there were challenges on the ground because of which we saw some higher churn, but that trend also improved in Q4. We crossed annualized revenue run rate of $10 billion, and with very strong 45% YOY increase in the RGIL EBITDA for FY21 to 31,461 crores. We've continued to work on the 5G stack. We completed testing of the completely in-house developed end-to-end radio and core networks solution. We have actually started deploying the solutions on the field, and we have seen good success. We delivering over 1 Gbps throughput on our own RAN with our own core network. In addition, we launched and scaled up multiple platforms like the JioMart, which has been very successful, and Dinesh is going to speak a bit more about that. But just enabling the technology for JioMart, JioMeet, JioHaptic, so a whole lot of platform innovations and deployments that we did during the year. And also working with our partners like Facebook and Google and other partners for newer areas like devices, like commerce, etc. So we've achieved significant milestones in what has generally been a challenging year. Things started improving in Q4, but we are again back to the second phase, which is proving to be much more challenging. Next slide. So we've come across this another phase which is much more severe due to this new wave of COVID. We have had to reshape our priorities. For now, the priorities are to minimize any business disruption, be it to our customers, be it to our channel partners, or even to employees. We have to just make sure that everyone is safe, and given the criticality of the service that we offer, we can't afford any disruptions, and that's why we have taken a whole lot of initiatives. One, towards the customer with a customer focus, where we are reaching out to customers to help them onboard, help them recharge. We are actually going to the customer doorsteps to offer services. We have expanded the Jio Associate program that we spoke about a few quarters ago when COVID had just started, where we are enabling the offline merchants who are not able to open their stores to really still work as our associates. We are enabling others as well to step in and help in helping customers with their requirements, and doing other businesses as well. So this whole Jio Associate program has been very successful on the ground. Network becomes very important, and therefore to use all of the automation and network virtualization that we have done, so that there is zero impact on network. And we're proud to report that through the last year, despite all the challenges on the ground, our network, LTE network, was up 100% of the time, and we offered services across the country. Given the criticality of the service, given a lot of people are now working from home, learning from home, there's healthcare at home, there's a whole lot of things being done digitally, we could sustain 100% network performance for all of them. Also, just ensuring that our employees, our vendors, our partners, their family members are all safe during this time. We are taking a lot of making a lot of effort on safety measures and protocols, just ensuring all of those are followed at all times, and that's a priority. That comes before any business initiative. We have to just ensure safety for everyone. We've launched the vaccination program application platform called R Suraksha for all of the employees, partners, and their family members, and that's as Srini started off this presentation, that's a priority across all of our businesses. One of the developments in the last quarter was a spectrum auction, where we participated and we enhanced our spectrum footprint between that auction and the spectrum that we acquired through a spectrum trading arrangement that we have entered into with Bharti Airtel. We have now taken our spectrum footprint to 1,732 megahertz. This now gives us 2 into 10 megahertz of spectrum in the 1800 band across all of the circles, 40 megahertz of contiguous spectrum in the 2300 band across all of the circles, and 2 into 10 in 800 band across 18 of the 22 circles. The average life of the spectrum is the longest in the industry at close to 16 years, and all of the spectrum is suitable to even deploy 5G technology as well as our narrowband IoT that we have gone commercially live with. The total cost of spectrum purchase was 57,123 crores, and with an upfront payment of 19,939 crores. This is the spectrum that we acquired the right to use in the spectrum auction. And in addition, we did a spectrum trading transaction with Bharti Airtel, where we acquired spectrum in the 800 megahertz band from Airtel for 1,497 crores, out of which 459 is deferred payment liability. So with this, and if we just move to the next slide, we believe we have the spectrum to now address the next 300 million subscribers. As you can see this chart, we've got a very healthy footprint across 800, 1800, and 2300 band, and a strong footprint of a lot of contiguous spectrum as well, which will support deployment, much more spectral efficiency, and deployment of 5G as we move forward. The other initiatives during the quarter, we launched the JioPhone 2021 offer for customers who need to be upgraded to digital services. This is part of the initiative on the 2G Mukt Bharat, where we need to provide affordable and good quality devices to customers. Of course, there's more coming in the next few months, as you all are aware. But during this quarter, we expanded the JioPhone program with an offer of 1,999 for 2-year unlimited services and the JioPhone, and a 1-year plan at 1,499. And we have seen a good success, good uptake of this from customers. And this is really a unique bundling of device connectivity and content for the customer. And there are more initiatives in the pipeline on this front. And the other initiative we took was, despite the COVID challenges, where most markets are still very gradually opening up, we went into the market with our enterprise offering to at least start testing it out in the market, getting customer feedback, which has all been very positive so far. This is an integrated offering for enterprise customers, including connectivity, digital solutions, and devices in certain plans. So basically, an end-to-end offering to the enterprise customers, where through one provider they can get access to connectivity and to most of the tools and applications that they need for running their day-to-day business. We have monthly plans starting from 900 rupees going up to 10,000, targeting all of the MSMEs in India. We've had a good start to this program, a lot of demand coming through, a lot of queries coming through. Again, something like this does require reaching out to enterprises, and that gets impacted during COVID. But we are in a fairly good position with the feedback we've received and the interest in the program to really scale it up significantly as restrictions on the ground reduce. The other area that we have worked on is just trying to catalyze the online gaming culture in India. We have hosted multiple virtual tournaments for gaming. We have tied up with partners both in India and global to bring these gaming programs for our customers. We have run these as campaigns. We've run these as competitions, which are being broadcasted on Jio TV and YouTube. And basically to get both gaming culture, which is already becoming more prevalent in the country, but also to get very useful customer feedback as to what they like and how we can build on these to really grow this as another segment from our point of view. Coming to the operating and financial numbers, we ended the quarter at 426.2 million subscribers. That's a gross addition of 31.2 for the quarter and 99.3 for the full year. Net additions of a little over 15 million, which was fairly good considering that COVID-related issues were there in still several parts of the country. Things had started improving, which resulted in the gross additions picking up again. We have seen recent challenges on the COVID front with the lockdowns, and we have to just be prepared for it, and we have to just ensure that we minimize any disruptions and customers are able to continue to take up services and enjoy our services. On the financial performance front, JPL EBITDA for the full year was 32,359 crore, driven by 45% YOY increase in RJIL EBITDA. despite the COVID challenges. Quarterly EBITDA for JPL was at 8,573 crore with an EBITDA margin of 46.9%. The ARPU at 138 rupees, as you all are aware, we moved to the bill and keep regime for 1st of January 2021, which meant that our IUC revenues from off-net calls came down to zero. Our costs also came down. So there almost a similar impact on both the revenue and the cost side. So the ARPU therefore reduced from the 151 rupees reported last quarter to 138. Combination of that and just this lesser number of days in this quarter, but primarily being driven by the reduction in IUC revenues. And then really the other area to talk about, and we have covered that already in this presentation, is various on-the-ground initiatives being undertaken for to really address the challenges we are facing and our employees and customers are facing on account of COVID. So a strong close to a challenging year. The connectivity business continues to perform very strongly. We are ranked number one. We are the largest operator in the country with 426.2 million customers. Market leadership in 19 out of the 22 circles with a 45% revenue market share, AGR market share, and growing. We carry more than 5 exabyte, now getting close to 6 exabyte of traffic on our network per month with sustained network performance. And we have now created a lot more capacity as well with the new spectrum that we've acquired, which is going to get deployed in the next few weeks. Our reach continues to be the widest of 4G LTE, and with our differentiated sales and distribution approach, and now going really to the doorstep of the customers, helping customers come onto the network. So a very superior network and value proposition, which has helped us achieve the market share that we've got in the market. The RJIL financials trends summarized on a slide. Our revenues, operating revenues, have grown from 14,835 crores same quarter last year to 17,358 this year. The dip is on account of the IUC revenues that I spoke about. EBITDA continues to grow. The EBITDA has grown by 34.1% year on year, from the 6,200 crores to 8,313 crores. The EBITDA margin for RJIL was at 47.9% for the quarter, very healthy, and it's industry leading EBITDA margin really. Next, key operating metrics. We spoke about the customer base, ARPU at 138.2 rupees, total data consumption at 1,668 crore GBs during the quarter, which is 13.3 GB per user per month on a base of 426 million. That's a sizable increase from the previous quarter, and that really is because our services have been the digital lifeline for a whole lot of customers, and we are proud we have been able to deliver them good quality services during this difficult period. Voice traffic also increased for the quarter. It went up to 823 minutes per user per month. Next. And the summary of the JPL financials. Operating revenues for the quarter at 18,278 crores and EBITDA at 8,573 crores. Net profit of 3,508 crores, which is a 47.5% year-on-year increase in net profit. So very strong growth across all operating and financial parameters, despite the COVID-related challenges, which continues to be there. There was some let-up, but continues to be there on the ground. I'll now hand over to Dinesh to take you through the Reliance retail performance.
Thank you, Anshuman. Good evening, everyone. As I talk through retail, let me start with a roundup of the full year's performance. We see the performance for the year as clearly resilient, and I say that for a couple of reasons. It was an unprecedented year. It was a challenging operating context in which we operated. If I look at our stores, we were open only for 80%. 80% of our stores were open. Our footfalls that we saw were about 65% of pre-COVID levels. First quarter pretty much washed out. Second quarter heavily constrained by the situation, and it's only the third and the fourth quarter that we started to see easing of operating conditions. And in that context, the retail business has recovered its revenues to come in almost at par with last year. Headline revenues are a tad lower, marginally lower compared to last year, but when I adjusted for the operating context and the fact that we transferred out the petrol retailing business, you'd be aware, and we've spoken about this in the past, we transferred out the petrol retailing business from Reliance Retail to the RBML JV when that was formed, and that was a drag of about 9,000 crores odd on the revenue. So when you adjust for it, apples to apples, we're marginally ahead on last year's revenues, which was a significant comeback from where we started the year with the lockdown. EBITDA performance was at an all-time high, and you'd recall, as COVID had struck, we'd spoken to you about a fairly ambitious cost management program that we had embarked upon, which has stood us in good stead. The benefits of those cost management initiatives have played out through the year, and then as the business has rebounded, EBITDA has kind of come back. It's been boosted by investment income that's come along the way as well from some of the surplus funds that we've invested in mutual funds. We've continued to stick on to the path of expansion. Even in a year like this, we've expanded capabilities, digital commerce platforms across all our businesses. We had it only for fashion and lifestyle. We've now expanded that across fashion and lifestyle has scaled up. JioMart was launched. Reliance Digital was activated, and then for our premium and luxury brands business, we scaled those up as well. So significant progress on that front. We've rolled out new commerce, and we're increasingly recruiting and working in partnership with a range of merchants across consumption baskets. And I think the one piece which we're particularly heartened about is the fact that we brought the Reliance Retail mission to life, which is really about enhancing livelihoods. And in a year like this, when it was probably most needed, a pressing priority, the retail business has created job opportunities for over 65,000 people since the start of the pandemic. We've continued to invest in acquisitions with a view on the longer term of this business. And these are acquisitions you would have read and heard us speak about in the space of really strengthening our capabilities in supply chain, last mile fulfillment, technology platforms, and really filling white spaces on the portfolio. And we will talk about some of these acquisitions in the quarters ahead as we start to scale them up. And then, of course, was the landmark event of the largest fundraise that we executed between September, October last year, the largest in the consumer and retail sector in India. So a quick set of headline numbers. Gross revenue came in at 1,57,600 odd crores. That, from a headline perspective, as I mentioned, was about 3% lower, but when you adjust it for petrol retailing, it's actually marginally higher than last year, apples to apples. EBITDA at 9,800 thereabouts represents an all-time high and particularly heartening given the operating context in which this was delivered. Of course, it received a boost from about 1,300 crores of investment income. But as you look forward, as these funds get deployed into a range of investments that we have planned for the business, over a period of time, we see the investment income being replaced by EBITDA and operating profit from some of the new investments and businesses that we will be getting into. Profit after tax at 5,500 thereabouts again represents an all-time high. So really, that's the big call out. Revenues at par or marginally ahead on an apples-to-apples basis, and profit at an all-time high. So let me now zoom in and give you a sense on the fourth quarter. Let me start with the operating context. And I call it out saying this was the operating context till March because, as we're all aware, things have changed quite dramatically since then. But really, we thought the operating context was inching back towards normal, not quite the pre-COVID normal, but clearly a normal that had been building up with each progressive quarter. Stores were open for about 95% of our stores were open across the network. Footfalls were coming back, improving quarter after quarter, 75% in quarter 3, 88% in quarter 4. So directionally, it was starting to come back. And restrictions and limitations across the geographies were starting to ebb and ease out. So that was one context. So clearly much better trading conditions in quarter 4 relative to the preceding quarters. Small towns have continued to lead the performance, and when you look at it across the breadth of our business, whether it's fashion, lifestyle, grocery, electronics, pretty much across all businesses, small towns have led the way. And then, of course, I will talk about what happened with the COVID wave 2 emergence that happened in March, but that dampened sentiment and that started to disrupt operations, and we'll talk about that a little later as we go through my presentation. So against the backdrop of this environment, the fourth quarter was clearly a landmark quarter for Reliance Retail. Our revenues were at an all-time high, our quarterly revenues, and our quarterly EBITDA was at an all-time high as well. We were back to the commentary that you've been used to hearing from Reliance Retail before COVID had struck, which is the fact that our growth was broad-based, all categories delivering very strong performances. It is another quarter of a strong EBITDA delivery. And the profit after tax has now crossed a milestone of 2,000 crores for the first time. The pace of new store expansion has stepped up, and you'll see this reflected in a couple of slides from now. And quarter 4 was higher than all the preceding quarters put together. And we've continued to scale up digital commerce and merchant partnerships across our businesses. So talking a little bit about revenues, just to give you a sense, it is a record revenue performance, growth of about 35% year on year. Fashion and lifestyle and groceries have registered all-time highs. You heard Srikanth call this out. And as trading conditions have improved, as footfalls have improved, as stores have been allowed to operate, clearly businesses are coming back, had started to come back to their normal rhythm. A very strong growth in consumer electronics. And you just heard Anshuman talk about the relaunch of JioPhone, and that clearly has helped boost the performance of consumer electronics. So stepped up device sales that hadn't happened for the last few quarters, but clearly a big factor that has boosted the performance of electronics in this quarter. Digital and new commerce is now 10% of our sales, and this is fundamentally businesses that we did not have right up until 12 months back, wasn't sizable, and today is about 10% of our business, with exit run rates clearly much higher and growing fast. We've had a drag from the transfer of the petrol retailing business. That's about 3,500 crores in the quarter, and I want to call that out specifically because it is a significant impact. But as you would have made out from our headline numbers, that's been made up from new streams and the businesses that we've been building out. On profit, resilient profit, it's now a couple of quarters where we've spoken about all-time highs. It's been 41% up EBITDA this quarter over the last year, led by consumer electronics. Clearly, the fact that devices sales have come back to a rhythm that we might have been used to seeing in the past has helped cause, and that's enabled the consumer electronics business to double its EBITDA. The benefit of cost management initiatives that we had embarked on early in the year have continued to play out, and you've heard us talk about this quarter after quarter. Very important to remind ourselves that for a retailing business, it's just so important, especially when there is a potential for operating deleverage as revenues go, and therefore we had embarked on this, and that's really paying out some benefits now. The boost has come from higher investment income, and margins have been maintained despite all the operating challenges that we've gone through and the limitations that we've had to operate in. This is the point I was making on accelerating store expansion, and we had started to build this rhythm. We had stopped because of the limitations in the first quarter, operating curbs, and then as quarters 2 and 3, we were allowed to operate. We were getting the rhythm back in that. Quarter 4, we've opened about 800 plus stores, and we were poised to open an even larger number in the current quarter. But of course, we'll now need to wait and see where that goes. But the rhythm on store opening is back. And the point I want to mention is notably, if you look across retailers anywhere around the world, it's unlikely that you would find too many who would talk about store expansion of this order of magnitude or offline expansion of this order of magnitude in a COVID-constrained era. So I think clearly a notable point to call out in that one, as we've opened about a little under 1,500 stores in this last financial year, taking the exit store count to about 12,700 odd stores. So the quick financial summary for the quarter: revenues of about 47,000 crores was up 24% over last quarter and 23% over the previous quarter. This is headline revenues. EBITDA at a new high that you're seeing at 3,600 crores. Last time was the first time, last quarter was the first time we had breached the 3,000 crores. That was a new milestone in itself, and we've bettered that. And profit after tax again represents a new high at 2,247 crores, which is up 45% over the same time last year. So let me give you a sense now of how it's played out across, a quick set of a sense of what's gone behind the numbers. So when you look at consumer electronics, very strong double-digit growth. The rhythm of the business has continued to be maintained, strong performances across stores and digital commerce. And the one which had been dragging down electronics performance in the last couple of quarters was the unavailability of devices, which is now behind us. And clearly devices with the launch of JioPhone has really come back and bolstered the revenues of this business. I think this business over a period of time has really found its secret sauce of what it takes to be able to win in this market. Impactful activation around events, around festivals, affordability programs, the best in the street that we have to offer, and then leveraging our partnerships with vendors and brand owners to really drive a lot of exclusive stuff that comes through our network. And I think that's the same thing which has played out in the course of the current quarter as well, and led to this growth. Growth was broad-based. Pretty much all categories delivered strong growths, clearly led by productivity devices, appliances, televisions, and air conditioning. Delayed winter, but a strong start to winter, delayed summer, and therefore, as summer came in much later, a very strong start to the summer loading in air care that we had. Bounce back on the devices sales led by JioPhones, you've heard that. And now I think over a period of time, you've heard us talk about the fact that we wired up the entire store network. We are omni-enabled it, which means today we can fulfill digital commerce orders through our stores. And what we've now also done is to ensure that all our DCs are omni-enabled. So in the event that stores are not entirely accessible, we can service orders out of our DCs. In any case, we've really worked and tightened our service level deliveries on what we send out of our DCs and our stores. You've heard me talk about the stores in the past, but now 80% of what we're delivering out of the DCs are done in under 24 hours. And that's an unparalleled or unmatched service proposition that we have to offer. And clearly upwards of 95% of the grab and go items that are ordered out of our stores and delivered out of our stores are delivered in under 6 hours. And that's now consistent and a unique proposition that Reliance Digital has to offer. We are expanding our own brand portfolio, and these are brands that we have licensed: BPL, Kelvinator, Disney, and then we have our own brands. Of course, you're familiar with JioPhones, and that's one big part of the portfolio, but there's Reconnect, which also participates in a host of other categories. We are building out that portfolio. We're now foraying into electricals, BPL, household name. Many of us have grown up with BPL. That's gotten into electricals, and we're now taking this across to general trade and working in partnership with a lot of general trade retailers as well. In fashion and lifestyle, it's been a buoyant quarter, and clearly footfalls were much better than they were in the preceding quarters. Revenue was buoyant and clearly largely led by higher conversions. We don't have all the footfalls that existed pre-COVID, and that's going to take a while to come back, because clearly, in just the pecking order of priorities from a consumer standpoint, fashion and apparel might rate much lower. And very conscious of that, what we've done is to drive conversion in store. So as customers come into store, how do you really drive conversions? How do you drive them to really cut bills? How do you drive more items? How do you drive bill values? And that's what has been the driver of business in our trends network. Small towns have done exceptionally well. In fact, small town stores are now 2x of what they were same time last year. And it just gives you a sense of the buoyancy of that part of the business. It's now contributing over half of the trends sales. And we've continued to integrate our trend store network, which by far is the largest fashion and lifestyle network in this country, onto JioMart. So now trends merchandise and items is available on JioMart as well, and orders have continued to grow 2x during this period of time. On Ajio, the momentum has continued in the last quarter, 4x over same time last year revenues. We've continued to grow the entire catalog, the entire range of offerings on Ajio. Options have moved up 2x over same time last year. Number of sellers, the number of brands are all significantly up, as this business positions itself as the leading fashion and lifestyle destination, offering a breadth of categories to consumers. And we've now launched a whole host of gamification elements, sales, impactful activation to really be able to consistently draw traffic onto this part of the business. And that's really in many ways helping us maintain the momentum on the entirety of the fashion and lifestyle and the apparel and footwear portfolio. On newcomers, we've expanded geographic reach. Some of you would remember the last time I presented, I spoke about the fact that we're at about 1,900 odd cities. We've expanded that to a little under 2,300. That's continuing to grow. Catalog size is up. We're looking to offer many more alternatives to merchants. But what we're also doing is addressing both sides of the spectrum. So not only are we growing merchant partnerships, and from a demand side are we addressing that part, but we are also building the supply side with many more sellers being onboarded. And so therefore this is a business which is being built up well for scale right across the country. And of course, we are starting to activate and use local events as the route to be able to onboard many more merchant partnerships across the country. The next business is Reliance Jewels, and Jewels has had a fantastic quarter. In fact, Jewels has had a fantastic quarter for a few quarters now. And what has buoyed the performance this time around is the fact that gold rates have come off, and that's led to very, very buoyant consumer demand. Business is up 1.8x over the same time last year, so it gives you a sense of how buoyant the business was. We've continued to leverage the design capabilities that we've been putting in this business for some time now. It's been a very conscious effort that's gone behind really building best-in-class, very contemporary design capabilities, and that benefit is now coming to the fore. We're now activating and we're ensuring we're getting in new collections far more regularly, far more thematic, far more contemporary, occasion where very focused assortments, which this entire capability is now allowing us to land. And that's becoming a contributor clearly to the very consistent performance that this business has been demonstrating. And we were also awarded the most admired emerging retail brand of the year. I think it's a coveted recognition and in many ways a testament to the fact that Reliance Jewels is now emerging as clearly a leading player in the jewelry and jewelry retailing space. On our partner brands, this is the luxury business. Clearly, the growth of digital commerce has continued. And I think we've taken a step forward. You've heard me talk about how we've built monobrand sites as stores have. This is a part of the business where stores were clearly impacted. A lot of them were in malls. So clearly, the need of the hour was to really create alternative routes of engaging with customers. And you've heard me speak about distance selling, creating digital commerce options, building monobrand sites for each of our brands. And we've continued to do that. What we also did in the quarter was to launch Agio Luxe, which is a curated section on the Agio app. Where we've listed about 60, a curated selection of 60 premium luxury and rich luxury brands. The intent, of course, is to scale this up given the number of partnerships that we have, but that now completes another addition to the Agio portfolio, which is the very luxury and the very niche offerings that it had missed so far. With the launch of Agio Luxe, that place gets filled. We continue to build monobrand sites and really tighten the functionality on those that exist. So Hamleys UK site was relaunched with significantly improved functionality. Brooks Brothers has come in, and this business has continued to really build up its position as a preferred partner to global brands. And the latest one that will now come in and open a store in Delhi is Tory Burch. So that's a new addition to the portfolio in the course of the quarter. Coming into grocery, this is a business where the revenues were at an all-time high in the quarter, clearly as it continues to serve customers far and wide. Footfalls haven't recovered as yet, as you would imagine, and that's really the role that JioMart is now starting to play. And so higher bill values continue to be a big driver of the performance of this business. I think the business has hit a landmark, and you'd be able to appreciate the magnitude of that when I tell you that on the 26th Jan day sale that we had, between our store network and JioMart, we served over 1 million customers, and that's happened for the very first time. So clearly a new benchmark, and that gives you a sense of the strong momentum across our grocery network, and as bolstered by the existence of JioMart. JioMart has continued to scale up, more orders, more traffic, clearly more customers. The assortment is 3 times more than it was when we launched it, and clearly that's continuing to grow. It's a very strong emphasis that we have to continue growing JioMart's assortment and offer the widest possible selection to customers. And just to give you a sense of JioMart, 80% of the orders that we receive in JioMart are from repeat customers, so very high level of repeats and order frequencies. And we slice and dice this just to give you a sense of what has been the behavioral pattern with customers who've been on JioMart. And we've seen that for those who've been with us for about 6 months, they order 1.5x more than some of the new customers who've gotten on, and their bill values are clearly higher, 20% higher than some of the newer customers who've joined onto JioMart. So it gives you a sense that with retention, customers are seeing the proposition and the value proposition that JioMart offers, and that's really leading to higher order frequencies and higher businesses coming in through higher bill values. On the Kirana program, we've now extended the coverage to 10 more cities. We're now active in 33 cities, and of course with some catchments that we're servicing in the vicinity. And clearly this is a function of how fast we are ramping up our supply chain network. But we're now in 33 cities. Merchant base has continued to expand 3x of where it was last quarter. Orders have continued to grow, and this again is where we just took a look and saw that for those who've been with us for about 6 months, their ordering frequency is 3x. So again, it gives you a sense that the proposition on JioMart Kiranas with the Kirana program is landing well, because it's clearly translating to higher frequency and higher purchase. We've initiated the JioMart exclusive Kirana program. This is the transformation that we do for Kirana stores to move out of closed store formats into open store formats. That has now started across 13 cities and was poised for ramp up in the course of the current quarter, but we'll wait and see where that goes. Uh, and of course, I think there are a whole host of functionalities which are being deployed across JioMart, whether it's on the B2C part or on the Kirana program, to really drive customer experience. Okay, and on pharma, I think this is a business which we're in the process of establishing. With as we start up our stores, we have 114 pharmacies which were operationalized in the course of the quarter. That's poised for ramp up because these pharmacy sections are embedded within our smart points at pharmacies. So that therefore that will ramp up as we open out our stores. We engaging customers through impactful activation, letting them know that we've now got pharmacies embedded within these smart point stores. And really a whole host of activities that are being taken. We're activating NetMeds, which we had acquired in September last year, in a whole round of impactful activation and campaigns which have gone behind it to really build mind measures. And I think for all of us who've been seeing IPL would see NetMeds has been very salient in this period, and we're continuing to see the benefits of that translate into higher orders and traffic onto the NetMeds site as well. We continue to grow the catalog we're testing hyperlocal, just as we have that capability existing across the rest of the business, of where we are able to service digital commerce orders through our store network. We're looking to do the same thing over here now as the store network comes online. So looking at a route to being able to service NetMeds orders through stores. That's a pilot which is currently underway and is poised for scale up as the rest of the store network comes online. So looking ahead, and this is really where we thought the rhythm in the market was starting to come back. Like I said, Q4 was distinctly better over the preceding quarters. And then, of course, this unfortunate development from March onwards that came along, making the current context very, very volatile and uncertain. I'm sure each of you relates to that from all that's currently happening. But it started to adversely impact business starting later March. Lockdowns, operating limitations that were imposed over time across states, and business, including digital commerce, was limited to only to essential items. Something that we've seen back last year as well, when clearly it was only essentials that were allowed to function and non-essentials part of the portfolio was restricted. Same issue across states, and therefore when you look at what's happening, our stores are down to 40-50% in electronics and fashion lifestyle. Very erratic. Obviously, because various states are going through various stages, but that's ballpark of where it has been in recent times. Grocery stores, even though essentials, have operated at anywhere between 80-90% because there have been geographies where this has been constrained, and this was considering the fact that it was operating at 90% plus in the last quarter. But even where we are operating for restricted hours. Many of you are familiar. Either it's 6 to 10, it's 7 to 11, it's 4 hours a day, it's a few hours with restricted portfolio very clearly. So much limitations, and I'd say that we're operating at just about half at the very best in terms of the efficiency of these stores. Footfalls are down. Footfalls have come down quite dramatically. We started to see it ebb from March itself, the latter part of March. They're currently at anywhere between 30-40% thereabouts of pre-COVID levels, and this was when we were just about hitting 90% in Q4. So it gives you a sense of the concern of how the business is now, of how the market conditions have kind of dropped. Vendor supply chains are starting to get impacted, and expectedly so, obviously, as the impact is far felt. And I think consumer sentiment this time around, I think the big change from what it was last time, and if I just use our experience of digital commerce as one of those indicators, I think consumer sentiment has taken a bit of a nosedive, has dipped quite significantly in recent quarters, and I think as consumers have made choices to really focus on just the essential purchases. Of course, it's also been impacted by the fact that clearly some states have restricted explicitly non-essential items. But I think when I look at some of our digital commerce, and just to give you a sense, when I look at some of our digital commerce orders in recent times compared to maybe the same time when we've had restrictions in the past, you can tell that sentiment this time around is actually quite subdued. So that's a little bit of the context that we are currently faced with. Looking ahead, if you can go to the next slide, please. So looking ahead, I just want to give you a sense of what's in it for the year in terms of our strategic agenda. And I'm saying this for the year because, given how fluid the current context is, the pace of execution, the pace of implementation, we will need to wait and watch. We'll need to see how it evolves and, how this entire thing pans out. But I just wanted to leave you with a sense of what's our big strategic thrusts in the course of this year. We're looking to continue to step up the pace of new store openings, and this is particularly in the space of grocery and fashion and lifestyle. We're looking to accelerate digital commerce. You've heard me say that before. Expand the category play on GeoMart and really make GeoMart the horizontal play that I've spoken about in the past. Grow new commerce merchant partnerships across businesses and across geographies. We are making significant progress. Run rates are clearly much higher, and therefore this is clearly a big part of the agenda for the current year. Launch and scale up our own brands and new businesses. And we've made a few acquisitions. You're familiar with the acquisitions that we made on Urban Ladder and Zivame. We're doing a whole bunch of stuff within the business, across our grocery business, across the brands business I spoke to you about in electronics. We have a large branded business in fashion and lifestyle. So really launching where we have white spaces and scaling up where we already have a business is an integral part of the agenda for the year. And really building the back end, a very strong foundation for the next wave of exponential growth for this business, expanding design centers, developing the vendor ecosystem for the aspirations that we have for the retail business, and really fast tracking supply chain infrastructure, across the breadth of our businesses, because that's such an important enabler for our business. Like I said, these are the strategic thrusts for the year in terms of how the pace of expansion and implementation and execution plays out in the next couple of months and quarters. We'll need to wait and watch, just given how uncertain and volatile the current context is, but just want to leave you with this. I think as we look at the immediate term, there is absolutely no doubt of the fact that our foremost priority is to ensure the safety of our people and the security of our operations. That's unequivocally our foremost priority, and business is a very second one after that, and that's really some of the decisive actions that we are currently taking and engaging on within the business. Most of the conversations are about how do we really secure people and secure operations, and that really is the need of the hour. So this really, in a sense, is the retail story for the quarter with the roundup of the full year. Before I hand over, let me wish you well. Stay safe and hang in there. With that, let me hand over the session to Sanjay for the next part. Sanjay, over to you. Thank you.
Thank you, Dinesh. A very good evening to everyone attending the call. Just to let you know, this has been a strong quarter in terms of both the production as well as the completion of the SAT cluster field. R cluster field that was commissioned in December of 20, we've reached peak production ahead of schedule by almost a couple of months. We are at about 12.8 million standard cubic meters per day. Meanwhile, the SAT cluster field, which we had envisaged would be commissioned by the middle of the year, was commissioned in April, the later part of April, and the field is smoothly ramping up, and we expect the overall production to be at about 18 million standard cubic meters in the next couple of months or so, which is around 20% of India's current gas production. So KGD6 production very much very much ahead of plans as of now. We continue to focus on now developing the MJ field, which we expect will be commissioned in second half of next year. In terms of the gas sales, as you're aware, we have conducted 3 rounds of bidding. One of these rounds included CBM and 2 rounds for KGD6. We did witness quite a lot of competitive bidding with participation from various industries, and eventually 19 successful bidders emerged. Now, in terms of gas prices, although there is a ceiling price that is applicable to the deep water, and that kind of constrains the price realization. But as you may be aware, prices have been far stronger. If you look back, almost a year back, 12 to 14 months back, prices had dipped below $2 per MMBTU. We are now seeing it consistently high and at about $8 per million BTU. Now, We expect that this will have an effect on the overall ceiling, and therefore the effect of the ceiling should wear off, and we should probably see at least a around 60% rise in the price realizations in the second half of the year. Like I mentioned, MJ, it's on track. We're making good progress there, and I'll talk a little bit about that in a subsequent slide. And just as you may be aware, we have successfully divested our interest in the U.S. shale Marcellus assets to Northern Oil and Gas. The transaction was closed in early April. In terms of revenue, as you can see, there's been the turnaround is mainly because of the production from KGD6, the R cluster, and the trajectory will continue. Our EBITDA margins will continue to improve as revenues, as production and revenues increase. As you can see, even in the price realizations, they're higher than what we had expected. And this is expecting the price, overall gas prices are expected to strengthen through the course of the year. Next slide, please. FY21, if you look at the overall performance, largely, our focus had been on delivery of the capital projects, which we despite the challenges of the COVID and so on, and all the challenges that we face globally in mobilizing the necessary resources, we managed to commission the R cluster field and now the SAT cluster field ahead of schedule. So what you see is more of a reflection of the operational performance through that year. But now from this year onwards, we expect this to the revenues to be coming in based on the production, and also improving prices to be far more stronger. So that's the outlook for FY22. Just a few pictures. As you can see, the installation campaign, the first installation campaign was undertaken, and we are now gearing up for the second installation campaign, wherein the subsea production system, as well as at a later juncture, the FPSO will be mobilized, and all of this will be connected together. Meanwhile, wells are being drilled even as we speak, and we expect to have those ready. And overall, we expect by the fourth quarter of FY23, we should commission the field. Meanwhile, our efforts continue to look at potential opportunities in proximity to the existing infrastructure, the deepwater gas infrastructure. Part of that in the KGU-DW1, which is contiguous to the KGD6 block. We have done the seismic acquisition campaign, and we're working on maturing some prospects. In case of success, we'll be able to tie back these discoveries into the existing infrastructure, and that should augment the production. So overall, we are all focused on the production from the assets, but more importantly, sustainability and business continuity, is a prime focus, and above all, the health and safety of our people and assets. We have commissioned bubble operations, to protect our people, and we're taking all the necessary measures. These are difficult times to undertake operations, to conduct projects, but we are doing everything we can. Particularly, our heart goes out and prayers to the frontline workers. And also, just wish you all to take care and stay safe. Thank you.
Yeah. So moving over to the last section on O2C, let me just start off with what are we doing for securing employees, and just to carry forward from what Sanjay said on the whole bio-bubble concept. Across all our manufacturing sites, we're providing accommodation for facilities for all our business partners. Work from home is percent of our people are work from home, and this includes technical and non-technical. Very aggressive testing protocols in place, using CCTVs and also AI for monitoring COVID hygiene behavior. Scaled up vaccinations a lot. 80% of the eligible people have been vaccinated, and we are expanding it to family members and also other contract employees. From a business continuity point of view, clear focus on raw materials, catalyst, chemicals, product dispatches, use of multimodal logistics, even hiring external storage, all of that from the context of business continuity. We have been able to complete our plant turnarounds in Hazira, Dahej, and Nagotane. Also, a lot of focus on lean shift operation, which means that by virtue of which we have been able to reduce the asset-facing employee by almost 33%. Here, just a slide, two slides on just the environment. Clearly, O2C business has benefited from the economic revival coming again on the back of rising consumer confidence, the whole vaccination drive, the US fiscal stimulus. If you see overall demand for oil definitely has risen from the lows, though on Q-on-Q I would say slightly lower in terms of demand. But otherwise, when you see even domestic oil product, again, demand year-on-year growth of 2.5%, flattish to slightly lower on a Q-on-Q basis. Again, within that, if you see gasoline, diesel up about 10% and 4% respectively on year-on-year. But ATF, you saw, almost 16% Q-on-Q growth. But when you see it in the broader context of the year, it is down 29%. Polymer and polyester demand up 12% and 21% respectively, though on a quarter-on-quarter, I would say was remained stable. Just carrying forward the macro trends, but when you see the price, you saw the big, jump in terms of price. Oil Brent up 38%, to $61. Naphtha prices were up, and along with demand, the fact that there has been a significant OPEC-led cut, and that continuation has helped. That combined with the whole fiscal side, stimulus side, has kept oil prices higher. Though the higher prices didn't really translate in terms of either an impact on the demand side. Also, the big trend was that in the previous quarter, we saw large-scale supply disruptions and logistical constraint. All of them, in some sense, benefiting margins. The whole historic Arctic freeze in US, led to shutdowns in refineries and crackers. In fact, global refinery cracking rates, if you see, is about 75% versus almost 86 in the previous quarter. And the container shortage, continued right through. And in that sense, it supported the whole margin environment. So if you look at specifically on polymers, I mentioned about the 12% year-on-year growth. PE, up 14% on really led by e-commerce packaging. Polypropylene up 18% on demand from non-woven segment, automobiles. PVC, is more to do with inventory destocking, because when you look at the price environment has been pretty sharp move upwards. But overall, when you look at polymer, both prices and margins are really in some way multi-year high. Again, as I mentioned, this did benefit from the weather-related dislocation. 75% of US crackers were affected because of this Arctic freeze, and also, as I mentioned, that gave opportunities for regional, for Asian producers to look at opportunities to the west, and also the whole container point that I mentioned did help to keep margins high. On the polyester side, again, demand growth strong 21% and across. If you were to see, and benefiting really from higher cotton prices, further downstream operating rates were good, declining inventories. Demand has actually come back to the pre-COVID levels. But when you see sector-wise, beverages, textiles, all of them, between 14 and 20% higher. The whole, when you look at the chain deltas at $541, really it's 18% higher. Again, coming on the back of strong demand, and overall realizations has been good. Specifically, PTY and FDY had firm margins through. When you look at transportation fuels, quarter on quarter, as I mentioned, slightly lower if you look at gas oil as well as gasoline, which I will cover. But having said that, margins recovered again to $5.8 that you're seeing, right, coming from the US outages and resulting in cargoes moving from Asia. Overall, when you look at ATF, overall mobility was actually slightly lower, 54% versus 56. But you did see domestic travel in many countries starting to normalize, and that also that explains the upward move in terms of the cracks from 2.4 to 3.3. On gasoline side, as I mentioned, slightly lower, but again, for the quarter, the sharp jump again coming because of the U.S. Arctic freeze. Also, U.S. Starting to benefit from healthy road mobility indices, which are looking up. But yes, it must be noted that the demand did decline for the second consecutive quarter. And yes, the onset of the second wave, is expected to put some pressure on gasoline cracks. So when you look at overall throughput, 2.7% higher, we have maximized ethane and SRFO in view of the attractive economics. Also, from a crude sourcing point of view, we have looked at arbitrage barrels coming from the Black Sea as well as the North American crude. We were able to run our manufacturing facilities at full capacity. Crackers were at full throughput, and we did rebalance both naphtha and ethane cracking, based on the optimization economics. The increase in transportation fuel at 9.9 versus 9.7. That's really more of jet fuel production that you're seeing. Otherwise, on polymer, fiber intermediates, and polyester, it was absolutely the same level as what it was in the third quarter. So when you put all this together in terms of numbers, 11,407 crores of EBITDA, which is up 17% that I mentioned. Revenue is also up about 21%. Again, when you look at it, it is EBITDA is explained by volume growth. It is also explained by the cracks improving across transportation fuels, and also I would say, multi-year highs for margins in key polymer products. If you look at polypropylene up 43%, cracks, PX 38%, MEG 33%. So you have seen that kind of sharp move up in terms of margins. Also, the fact that we were able to push a lot more of the products on the domestic side, really leveraging our multimodal, India distribution help. So when you look at the numbers in aggregate, overall revenues unexpectedly, it is lower on the back of both, the first half being what it was in terms of both demand contraction and also the whole margin side. Second half did bounce back, and our operating model and our agility is what helped to protect a lot more of the EBITDA. We were able to run our facilities at 100%. The switch from domestic to export and back to domestic, our ability to optimize feedstock, helped. And if you look at it from demand side, except maybe the jet fuel side, almost every product had reached the pre-COVID level, and just before the second wave we are talking about. So here, the point I wanted to make was that what has helped us is the business model, where the focus is on high asset utilization without compromising on safety and reliability of operations. The optimization of feedstock product yields, the integration, the focus now on specialty component, so that we push for more niche and higher margin grades. The whole supply chain management, including the whole broader focus on customer ownership, both through trading as well as the distribution I talked about, the ability to price differently for the product portfolio. All this has really helped mitigate what would have otherwise been a very big impact in terms of earnings. Otherwise, therefore, if you see our own growth, the last 3 quarters, it has been a series of sequential improvements in all the 3 quarters, but the strong first half because of COVID did pull the overall performance down. So here, just wanted to say that oil demand recovery, in 2021, it will still be, even by all the estimates, is expected to be still lower than what we saw in 19. Yes, there is the broader cracker capacity additions that we saw in 2020, as well as what we expect to see in 21. But overall margin, I think the whole easing of lockdowns outside India, the US driving season, as well as some aspect of travel recovery, can support fuel cracks. We think polyester chain deltas are continuing to do well, especially if you're an integrated player. The container shortages in the near term, could be generally supportive of margins, and any delays in the capex side could also be a short-term tailwind for broader margin. Overall, demand drivers continue to be vaccination-led, the impact of the fiscal side, but also from an India standpoint, some of the longer-term demand drivers, including the scrappage policy, the investments further downstream, especially in this whole flexible containers and geosynthetics, pipes, etc., and hygiene, of course, are long-term catalysts for growth. But clearly, the near term is about the second wave in India in terms of lockdowns. I know a lot has been said about it, but that is where it is. Yeah. With this, I just wanted to come to the summary, and here I did want to highlight the fact that when I look at all the businesses, O2C, digital, retail, standout has been the strong operating performance. It has been unprecedented business environment. We all know that, but on the ground, it is, it has been extraordinarily difficult. But in that environment, the performance I would just characterize as being very strong. A consumer business is now almost 49% of our EBITDA. Retail and Geo have been providing both physical and digital lifeline to customers, and the continuing focus on creating capabilities across our consumer and technology-led growth. Clearly, the focus on agile operations, the delivering on our operating model potential, as well as our competitive cost position, has helped us deliver that kind of performance. Sanjay talked about the revival in upstream business, with the commencement of R series and the satellite fields and ahead of plan. That I think will be potential drivers for growth going into FY22. And then finally, our balance sheet is very strong, highly liquid, which really supports the next phase of growth. With this, I would like to thank you all for being on the call, and request you to all be safe. Thank you so much.
Thank you, everyone.
Thank you.